All right, let's just get right into it. Wall Street just wrapped up its worst week since this whole Middle East conflict kicked off. And honestly, a risk-off feeling has just completely taken over. We're calling it the fear premium, and it is everywhere. So, just how bad was it? Well, the S&P 500 got slammed, dropping 1.67%. I mean, that's over 108 points. This wasn't some tiny little dip. This was the market flashing a giant red warning light. And this wasn't just a one-off thing. Nope. The Dow Jones fell right alongside it, losing almost 800 points. That's a 1.73% drop. We're talking selling pressure absolutely everywhere, even hitting those big, reliable blue-chip names. Okay, but the real headline today, that's got to be the Nasdaq. The tech-heavy index sank over 2%, and get this, it is now officially in correction territory. That is a huge psychological blow for investors. It's basically screaming that there is serious stress in the system, especially for all those high-flying tech stocks. So you're probably asking, what in the world is causing all this chaos? Well, it's pretty much a geopolitical shockwave. The big one is the escalating US-Iran conflict, right? With the Strait of Hormuz being this massive flashpoint. That sent Brent crude oil prices just exploding past $110 a barrel. And when oil does that, you know what comes next. Soaring inflation fears. All of this combined to trigger this massive flight to safety. And boom. That's how we end up with 5 straight weeks of market losses. All right, so with a sea of red on the screen, you'd think everything was down, right? Well, not exactly. There was one part of the market that was swimming completely against the tide. Let's kick off our deep dive with the absolute monster surge we saw from Exxon Mobil. I mean, just look at these numbers. Exxon jumped over 3.3% to close above $170 a share on a day where everything else is getting hammered. A move like that it's just staggering. It was basically the market's anchor, trying to hold things down while everything else was sinking. And that really gets to the why behind this move, right? This wasn't just a bunch of retail investors hopping on. No, this was the big money. We're talking institutional capital aggressively rotating, pulling their money out of those vulnerable tech stocks and plowing it directly into major oil producers like Exxon. They're basically treating the energy sector as the market's #1 hedge against both inflation and this conflict. It's become Wall Street's favorite life raft in a storm. Okay, so if all that money was flowing into energy, where was it flowing out of? Well, let's flip to the other side of that coin and look at the king of AI, Nvidia, which really felt the full weight of all this market anxiety today. So Nvidia slipped 2.17%, and that alone was a huge drag on the entire Nasdaq. Now you have to remember, this is a stock that has been on an unbelievable tear. So when a market leader like this pulls back, everybody, and I mean everybody, sits up and pays attention. And this right here is a textbook example of what traders call macro de-risking. What happened to Nvidia today had nothing to do with its AI business being bad. Let's be clear, its growth story is still insane. No. This was all about big institutions getting scared. When oil prices are flying and geopolitical fear is this high, they're forced to sell their biggest winners to lower their overall risk. So they sell stocks like Nvidia. It just goes to show, even the king of AI isn't immune to a panic. All right, for our last deep dive, let's talk about Meta. Because with this one, the story gets even more complicated. You had the broad market fear, sure, but that got piled on top of a really severe company-specific issue. Meta took an absolute nosedive, plunging almost 4% today. And this wasn't just a one-day thing. It was a continuation of some really sustained, heavy selling pressure we've been seeing. It's been a painful trend. So what's the deal here? Well, Meta is still reeling from that landmark court ruling on social media addiction liability. There's this quote that just sums it up perfectly. The sudden injection of unquantifiable legal and regulatory risk has just completely shattered institutional confidence. The market hates uncertainty. And right now, nobody knows how to price in this huge unknown potential cost. So what do? They sell first and ask questions later. Okay, that's the deep dive. So what does this all mean for you? Let's boil it all down into the key takeaways. This is your ammo for sounding shark, maybe at the water cooler tomorrow morning. Here's your first talking point. It's about Exxon. You can say, Exxon jumping over 3% is the perfect data point to bring up when discussing inflation hedges. Maintaining a heavy energy overweight is absolutely critical for capital preservation. Next up, what do you say about Nvidia? Here's the line. Nvidia slipping 2% isn't about AI fundamentals, it's a pure macro de-risking event. It might be time to start looking at entry points for the growth portfolios. And finally, for Meta, here's the smart take. Meta dropping another 4% shows that the recent legal rulings aren't just a flash in the pan. We have to start actively modeling in the cost of algorithmic liability. So, to wrap it all up, Nvidia and Meta took a heavy beating today as the Nasdaq officially entered correction territory. The big question for you is, are you using this geopolitical fear to buy the dip on your favorite tech giants? Or are you staying on the sidelines? Comment below, subscribe to Market Fluency for your daily edge.